Thank you. Hello, everybody. Very good evening for today's session. As you may, see in front of your screen, we're going to discuss on a very interesting topic. Of course, the entire income taxation or direct taxation, international taxation, have always been very interesting. This is more than the interesting aspect to it, what is very essential here to look at is the practicality of it, considering the fact that in practice, the amount of globalization we have seen, the significance of, as much as we focus on resident taxation, the focus on non-resident taxation has proliferated significantly over the past couple of decades, especially post-liberalization, no looking back in terms of foreign investments we've got. And the fact of the matter is now it has got very interesting because at one point in time, India had a lot of brain drain. What I mean by brain drain is, when even before liberalization, many of our previous generations migrated to the first world countries for better living and access to academics and better quality of living from a monetary as well as from a standard of living aspect. And considering the fact that India has grown exponentially, became one of the most emerging developing economy, there is also of late there is significant amount of brain gain happening. So people are keen to come back to India because they feel it's a different India in terms of development, infrastructurally, economically, and also the fact that even otherwise in terms of people who've been investing, the diaspora community plays a very, very significant role in the investment as well. So therefore, the Indian diaspora community in terms of their relations, so they're continuing their nexus with India, which all the more from a tax standpoint, very essential for the fact that, how do those non-resident Indians get taxed? And that apart, even Indian origin, who are not NRIs per se, who are maybe overseas citizens of India, who've got citizenship from another country, but still has Indian origins, they contribute a lot to Indian investment. And they continue to hold some sort of a nexus with India in terms of investment, real estate, businesses, etc., deposits. So therefore, very, very essential from a practice aspects, considering the amount of global movement and massive globalization epoch that we have witnessed. So with this, for the next 5 sessions, I'll be focusing on the non-resident taxation aspects. Now, having said that, it's a pretty broad topic in its sense. There are quite a lot of aspects that one need to reckon with while dealing with non-resident taxation. Now, before I'm sure many of you are slowly getting onto the screens as well, but before I get on to the scheme of things for today, I thought let me do some quick warm-ups for you, because just to understand, probably refresh and go back in understanding certain aspects which you would have done in your articleship or even in your intermediate level, the APC stage. So just I want you to answer this in the screen as well. Now, I will give you, I'm not going to read them out, so I will leave you to answer them rather. So I'll give you just a couple of minutes. So keep flowing your answers, more like a warm-up, just to, probably fire up your brain or to prepare yourself what is going to be for the next few days. This will also, in a way, set the base or set the tone for what is that we're going to look forward in the next 4 or 5 sessions. If you're done with it, I'll move on to just few warm-ups, not much. I would really appreciate if you all give it a try. That will these are aspects which are relevant as well. So please feel free to key in and put in your perspective. I give another couple of minutes for you to take these warm-up questions or probably share your views. Of course, quite a few are pretty easy, straightforward, basic element. Okay. So let me just quickly got it. Thanks for those who have contributed. Who have not, who are just getting up, please feel free to still contribute. Now, what is India's tax system? Is it a territorial basis? Is it a worldwide? I see Geeta mentioning this as a territorial. Very interesting. Worldwide, neither of the above. Okay, global income, residence. For a second. Okay. Right. All right. So India's basically tax system is worldwide basis of tax system. There are two essential ways which taxation happens. One is your global income will get taxed, and territorial. Under the territorial, which countries like Hong Kong, even France, as a matter of fact, they are only concerned about what is the income you get in that territory. When it comes to India, India goes on a worldwide basis, which is quite prevalent in many countries. Quite a few developed as well, US, UK. Many of the countries in the world go for a global basis of taxation or the worldwide basis of taxation, because of the fact that why worldwide basis? What benefit it gets? Because it clubs both your source as well as your residence base, which is the fulcrum of our international tax or our tax system. When I mean that, what I mean by that is normally tax systems are designed by ability to pay. That is how much income you get, you have to pay. So the residence are normally goes on ability to pay. And also one more concept called the benefit theory. The country giving you certain benefits. So therefore, you need to, if you're making use of those benefits, it's a social contract. Why do I have to pay tax? It's a social contract that I have entered, so that I'm paying. So this ability to pay and the benefit theory is pretty significant in designing a tax policy. Now, there are okay. That's the okay. So that's the only way in which the normally is two designs. So in a source, normally in territorial basis, they're very happy to get only those income. That is, whatever is the benefit theory, how much ever you use the infrastructure, pay that. I'm not concerned about your worldwide income. Very few countries in the world go on a territorial basis. That is, whatever source of income you get, you pay in that. Now, India goes on a worldwide, meaning, pay, if you're a resident, pay. If you're only a non-resident, pay only to the income that you get from India. So, which basically clubs both the taxation principle, that is your ability to pay as well as your benefit theory. Now, moving on to my next one, is tax laws are determined based on nationality, citizenship, or residence. I did see, just quickly move to the other screen to see. Tax law based on resident, Indian tax law. What I meant here is Indian tax law, nationality, citizenship, and residence. This can actually, work with not necessarily tax laws, any law, as a matter of fact. The reason for me I'm saying this is not only from India perspective, even from non-India perspective, we go on a residency basis of taxation. If you're a resident global, and if you're a non-resident, the source. Now, interestingly, citizenship-based taxation is not followed in any of the countries except for US. That's a small country in Africa. These are the two countries which go on a citizenship basis taxation. That is, I'm not bothered where you are resident, because if you know, be it in income tax or under the FEMA, the residenship is based on the physical days that you are present in that country. But when it comes to citizenship, I may have Indian citizenship, but I may be settled in Germany, I may be settled in US, Canada. Will I be liable to tax? Thankfully, India has not gone to citizenship basis, except for the recent amendment you would have seen under Section 6, Clause 1A, anti-abuse provision. I'll not get into it. You would have gone by it now for individuals. But otherwise, normally countries don't go for citizenship. US is an exception. It's a controversy that's going on for a very long time in US. US doesn't matter where you are resident. As long as you're a citizen, wherever you are settled, you may be US citizen, but settled in India fully. Still, you may have to pay taxes in the US. And there's one more small country in Africa called Ertica, taxes on a citizenship basis. Nationality. Nationality is normally equated to citizenship. Generally speaking, nationality is used in other public international laws. You take any international law, for example, refugee, migrants, Vande Bharat mission, which nationality you are. So they go by nationality, but tax is an exception to it. Tax focuses on residentship basis of taxation. In India, follows a residentship basis of taxation. And many countries in the world follow it. That is, number of days you are present in that country will determine your residential status. Now, quickly, the other three, non-residents are taxed in India. Straightforward, fundamental question. They are taxed only in their Indian income. So this is what. So non-residents, as you know, will again look into Section 5, are only taxed in their global income. So this is what in their Indian income. This is what we're going to discuss in the next few days. That's why you need a special regime for taxation of non-residents. Now, corporate entity status is determined by where it is incorporated or where its real seat is. Normally, for individuals, it's quite easy because physical days, 182 days, 729 days or less, quite easy to determine your residential status because they're natural person. What about artificial person? Can a company may be incorporated, registered in India, and I may also be registered in UAE, British Virgin Island, or some Caribbean island. So is that the incorporation matters? Where is that? Which register? Where am I incorporated? Where I'm set up? Where my charter documents are? MOA, AOA. Is that where my that's how will their residency being determined, or is it the real seat? Now this is a very prevalent concept, and you're going to see this as part of today's session as well. The real seat is I may be incorporated in one entity, but my operations, my functional aspects will be in a different country. Now, this concept evolved in Europe because if you see EU, European Union, is a regional union which comprises of 28 states put together. Now, one of the EU constitutional principles, fundamental freedoms are freedom of establishment, freedom of movement. So within Europe, you can move, you can set up, and it's a fundamental freedom. Right to establishment, right to move. So therefore, people will set up a company in Austria, but the office will be based out of Berlin or based out of Amsterdam. So that's called the real seat. So it's the incorporation theory versus the seat theory. That's how the corporate laws, global corporate laws, jargonize it as an incorporation theory vis-a-vis to a seat theory. Now, how it is relevant for income tax? If you look at India also, India goes by incorporation. If you are a registered Indian company, defined, if you're a domestic company or under, the definition of Indian company is also there. Which is incorporated in India. So in such a scenario, incorporation plays a role. But India also now has factored a place of effective management, which is one of the agenda items for today we are going to look at. So which will mean that I may not be registered in India or I may not be incorporated in India, but if my place of management is in India, then I become a tax resident. This is the reason why I had put this question, so that it will segue us into for today's session. And finally, just a last minute addition for this, just wanted to refresh your brain on the residential status for individuals, resident but not ordinary, because India has this third, you have a resident ordinary, you have a non-resident, but you also have in between a resident but not ordinary. This is basically for people who have come back to India to give them some settle down period, uh, to settle down, so that way they can manage their affairs. Now, resident but not ordinary resident is almost equivalent to a non-resident. Only their Indian income is taxable, except for one scenario. That is, if it's a foreign income, but however, if the foreign income is on account of a business or profession managed or set up from India. So that is, and now resident but not ordinary is very significant, especially in light of amendments that was made in Finance Act 2020 through to Section 6.1 and 6 Clause 1A. Now, with this warm up, I think it's a good starting point to get into today's session. Having seen an overall framework of how the residence versus source concept emanated. Now, one aspect that I would want to touch upon before I move on is, you may wonder, look, a resident is being taxed on a global basis. That is, say, Sudarshan sitting in Chennai, India, who's a tax resident of India. Tomorrow, I go give a lecture in a European university for European students, for which the European university pays me. Now, that amount, I have to show it in India because I'm a resident in India. So you may wonder, why is that? What is the nexus for that? Because taxation, one fundamental aspect that matters is, when it comes to taxation, there has to be some sort of an economic nexus with that country to tax. The economic nexus here is me being a resident. So this is where the benefit. The Indian government will say, okay, no problem, but you are Indian resident, you went to Europe and paid, but that's only a one-off event. Otherwise, I give you the infrastructure, I give you the road, I give you internet. So you need to pay. So therefore, residence is global taxation. This is, you may feel it is extraterritorial, but then Indian Constitution Article 243 allows extraterritorial operation. Not completely, but wherever there is some sort of an impact with India. I'll give you an example. There's this concept called FX doctrine. Now, FX doctrine is a very interesting doctrine emerged under competition law in US. For example, I don't know if you read the newspaper some time back. One of the US citizen wanted to file a case against China, the International Court of Justice, for the COVID virus, Wuhan, which emanated. Now, you may wonder, what is it with China's COVID? But under the US law, which all Commonwealth also follows, the FX doctrine, whereby if the impact is in US, then US, it's not extraterritorial. US has the right to sue or make a claim. So this FX doctrine is an international law, especially followed in common law countries. So, and when it comes to taxation, if you draw that analogy, the fundamental aspects, there has to be a nexus. So for residents, the nexus is their residentiality or citizenship or staying for a long number of days. For non-resident, very, very important is, for non-resident, there should again be a situs or a territorial nexus with India. Only then the non-residents can be taxed into India. Now, that is what we are going to see also as part of the syllabus is Section 9, where India has gone and said, deemed to occur arise in India. By deemingly, they say this will arise in India. We'll go deep into it. But the bottom line, or the point which I wanted to drive and which I want you all to keep in your mind, is the concept of territorial nexus. This is very important, especially in the digital world, because all these nexus concepts are, again, territorial nexus, or very nebulous. In the modern day world, it's getting very challenging. If I have a Bitcoin through some crypto exchange in Singapore? Is there a nexus because I'm an Indian resident having, so therefore the non-resident is making an income from an Indian, so there is a nexus. So it is going to be challenging. There is no clear answer to it. But all I wanted to tell you is the non-resident, when it comes to taxation of non-resident in India, there has to be some sort of a nexus with India. In other words, situs, there has to be a situs with India, territorial nexus with India. Nexus is basically connection with India. Only then, such income can be taxed. This is a global principle. Not necessarily for India, but this is a global principle. That's why US is arguing, by virtue of US citizenship is the nexus. He may be staying in Timbuktu. He might have settled down in Nigeria. Doesn't matter. He's still holding US citizenship. So therefore, US has nexus on that person. Same goes for India's residency status. For non-resident, one need to keep in mind that there always has to be some sort of a nexus or a connection in order to tax them in India. Failure to have a nexus or connection will deem it as an extraterritorial levy, which is not allowed. You need to understand taxation is a sovereign matter. Each country would want to tax people provided that the income is earned from that jurisdiction or through a resident or citizen. But otherwise, you cannot just like that a person is earning somewhere in, say, a transaction between Germany and Japan. India cannot go and say, no, pay tax. There has to be some sort of a nexus in order to levy taxes in India. So with this, just the screen before you gives a snapshot of what is that we are going to cover in the next few sessions. We look at basically encapsulate the non-resident taxation mechanism that is available under the Income Tax Act. There are also impact for residents in the form of withholding tax. So residents who deal with non-residents. Now, because India goes with a lot of TDS, so this also has impact for residents by virtue of withholding taxes, etc. So standalone taxation for non-resident, and also the impact what residents will have while dealing with non-residents. That is what the overall framework will be. There are certain presumptive taxation regimes that are available for non-residents. We're going to have a look at that, similar to your 44AD for residents. For non-resident businesses also, there are some presumptive tax mechanism. Why do we need that? And for what businesses? We'll dwell further. And then there are certain specific taxing mechanism for NRIs alone, not for other non-residents. Those who are non-resident Indians, that is, who are citizen of India and whose origin is in India. So for them, they get certain specific benefits. And then similarly, there are special cases of taxation for non-residents, which will not come under the other heads like applicants, PDVP. They'll be taxed separately under Chapter 12. For example, sportsperson. With the advent of IPL and other league sports in India, you see a lot of foreign players coming into India. They earn income in India. So those, how do they get taxed? Those mechanisms are available under Chapter 12, which deals exclusively. Similarly, as I mentioned to you, there are also some exemptions given to non-residents from taxing in India. So we will look at those exemptions available under Section 10. Now, so since we're getting on to having seen the fact that, resident and non-resident, and then similarly taxation in a source basis. Now, the fundamental aspect where it all starts is your Section 5 of which talks about scope. So if you look at Section 5, it says the scope of income is subject to tax in India. So Section 5 tells you which is the income that is subject to tax in India. And it is dependent on the residential status of, not necessarily individual, residential status of the taxpayer. It can be individual, company, EOP. The screen says individual, but it can be, is dependent on the residential status. So taxability in India is based on residential status, which is summarized. As you all know, for a resident, any income that is accrued or received in India, outside India, will become taxed. Any income deemed to accrue or arise in India will get taxed. Any income received in India deemed to be received in India taxed. And even income accrued and received outside India for resident and non-resident taxable. So in effect, the three streams of income: received, deemed to be received, accrue, deemed to accrue, all these aspects will get taxed for a resident. But when it comes to a not ordinary resident or a non-resident, we are basically focusing on non-residents. So for a non-resident, only those income that he receives in India by virtue of Section 7 will get taxed, deemed to be received in India, received and deemed to be received in India as per Section 7, income accrued or deemed to accrue in India. So received to be in India, deemed to be received in India, accrued in India, deemed to accrue in India. In these four situations, a non-resident will be taxable. If the income is accrued outside India, if the income is received outside India, then a non-resident will not be taxable. So this is the point I was trying to dwell. So a non-resident, if he has a nexus, what is the nexus? It should have been received in India, and it should have been deemed to be received in India. There is a section specifically stipulates what are the deemed to be received in India. Income accrues in India, and then income deemed to accrue or arise in India. Now, income accrue in India is one you'll be very familiar with, which has this, of course, it has a lot of controversies as well. But then at least, if there is a right to receive in India, and the origin point is in India, the source is in India, then it says accrue. Now, deemed to accrue arise in India is essentially where the Indian Tax Act or the tax legislation is the deeming certain, so it's a fiction, deeming certain incomes as they are accrued in India. So that way, India will get the taxing rights. And our focus will largely be on the deemed to accrue in India, because that's a fiction that is being created by the tax legislation, and we need to understand what are the incomes that is deemed to accrue in India. Because normally what will happen, a non-resident will say, I'll give you one example, very easy example. I have a property in India, and I'm a non-resident. I let out that property to a resident in India. I have a property in, say, in Bombay. I'm a non-resident staying in London. I let out the property to somebody in India. I collect the rent. Now, common sense will say, look, there's an asset in India, so income accrues in India. But on the other hand, I can always say, look, the rental agreement, for a moment, let's assume the rental agreement was executed in London. And I'll say only after the agreement was executed, the right to receive. So where was the agreement executed? The executed was in London. The contract says the agreement was executed. If there is any issue, everything will be into London courts. So therefore, one can say that the place of contract was in outside India, and therefore the agreement gives me the right to enforce the rent. So therefore, it is accrued outside India, and therefore this rental should not be taxable. So now, these were concepts that were used by non-residents using the contractual agreements to say that, these are not accrued in India. So therefore, the Indian government had to introduce a fiction, that is to give the statute priority over contract. You do whatever contract you want, I'm least bothered. Look, this is what the law says. I'm not concerned about the contract. I'm not concerned about the form. All I'm concerned is about the substance. So to legalize it and to make it effective, the government introduced the concept of deemed to accrue or arise in India. So for a non-resident, once if I come into the deeming provision, that is deemed to accrue or arise in India, then I will have to pay taxes under Section 5. So what is the outcome from Section 5? I need to know the residential status, the sources of income. When I mean sources of income, that is accrual or deemed to accrue or rise in India, received in India. Now, therefore, this is the two broad concepts which has emerged. My residential status is very important because if I become a non-resident, then only these aspects becomes relevant. So therefore, my residential status is very important. And then once I determine my residential status, I need to find out where the source of income is, whether it is accrue in India or deemed to accrue or rise in India. Now, this is what they call the residence and source mechanism, very popular under the international tax law principles. There's always an issue as to where is the source emanating, and that will always keep going on because, as I said, it's the question of which comes first, chicken or egg. It's the contract that comes, or is the property. So you'll always have this going on. But nevertheless, all you have to keep in mind is this: the first criteria of finding out residential. The next criteria is to find out the source of income, whether it is taxable in India. Now, this all comes under a principle called international equity. This is a international tax law policy frame that is fundamental, essential. As much as we are talking about equity, which is fairness of the tax, there has to be proper division of taxing rights between states. So that way, because a person who may not be a resident but will have to pay tax in the source state, but the resident state will also want to tax it. So therefore, you will always have this resident state conundrum. That's how the double taxation started to come in, because source state wanted to tax, resident state also wanted to tax. So that's how you started to enter into tax treaties to eliminate or resolve the double taxation issue. So just to summarize, the salient rules for taxation in a cross-border transaction. Cross-border transaction is a transaction between a resident and a non-resident. Resident pays tax in the home country. Resident may also pay tax in a source country, depending upon the domestic law of source country. And in the source country, that is, let's take you are a non-resident in India. Whether a non-resident in India, will he be taxed in India? You have to look at the domestic law provisions. And if it says taxable, then you need to follow the obligations, because income taxation is a combination of substantive law with the procedural law. Pay the necessary taxes, file return of income, and do all the other formalities. You can also check the double tax treaty to see who has the taxing rights. So therefore, if you are in a source country and you are a non-resident, then you need to look at the domestic law provisions of that source country to determine your taxability, which is what now we are going to see in India, in the Indian tax laws, because that for a moment we are talking about taxation of non-residents. So therefore, for non-residents, how is the taxation mechanism is governed in the domestic law? Your first will always be the domestic law of the source country. Only then you will go to tax treaty. You cannot go to tax treaty first, because tax treaty does not create any taxing rights. Taxing rights are created only in the domestic law. And the role of tax treaties is to only divide the taxing rights. So therefore, it is always important to start with the domestic law. And this is what we're going to look at for non-residents, whether or not they are taxable in India is what the entire objective of the next few sessions, and what are the mechanisms. Now, so the process normally would be, first residential nexus. Now, as I told you, we are concerned only about non-residents because when it comes to resident, India is pretty clear that your entire global income is taxable. So if you become a resident, then not an issue. But if you become a non-resident, then only your Indian income is taxable. Now, before we go into the taxability for non-residents, how it is governed, I think it's important to quickly look at the first step, determining the residential status. Now, obviously, many would prefer to be a non-resident because if you become a resident, then your global income is taxable in India, global reporting, a lot of issues. So people would, especially those who wants to avoid taxes, who wants to save taxes, or who are globe-trotting, they would want to keep their taxes minimal because they don't want to keep paying taxes in all the country. So they'll always try to have the non-resident status. So now first let's try to understand the residential aspect. I'm not going to focus on the individuals here because I think that is covered elsewhere. Now, my focus was largely going to be on corporates, which was also one of the warm-up questions that I had indicated. Now, for individuals, we are aware there are conditions, as I mentioned already, physical presence, stay is very relevant. Income Tax Act is all concerned about stay. How many days are you staying in India for individuals? Even FEMA, if you look, gives you a small benefit. Your intention matters in FEMA. That is, you might have stayed, but if your intention is not to stay in India, then you can always become a person resident outside India for FEMA. But when it comes to Income Tax Act, pretty simple, straightforward. 182 days have you stayed, 729 days have you. Forget about intention. COVID, not COVID, arrested, kidnapped, smuggled, flight delay, nothing matters. The act is very clear how many days you have stayed in India. No, and law has, and especially income tax laws, has looked into literally. Now, when it comes to company, now people were, early days when all this income tax started, there's very little movement of corporates. People used to move was always there, but corporate moving was unheard of. And especially in common law, incorporation theory, the definition was, you register in India under the MCA regulations, SPICE, whatever, and you have registered with the MCA or the ROC of the state, then you become an Indian company. Indian company is defined to that effect. Now, there's one more condition as well. This is there under the Income Tax Act. That is the poem. So, if you're an Indian company, straightforward, you become a resident. But if you are a foreign company incorporated in Singapore, because Indian company definition clearly says it has to be incorporated, registered in India. So a Singapore company cannot be an Indian company. But however, there's additional one more aspect given, or if you are a foreign company, that is a non-Indian company, if you're a foreign company, but if you have your poem, easy to remember poem, place of effective management in India, then you become a resident. Then you become a tax resident of India. Now, this is very, very significant for the fact that look, previously, when we had section 6.3, which was amended in 2016, the provision was like this. It is an Indian company. This is no issue, straightforward. Or if it's not an Indian company, it's a foreign company, and the control and management of its affairs is situated wholly in India. So this wording was obviously we derived from UK. So the control and management of that foreign company's affairs is situated wholly in India. So when you say wholly, it has to be 100%. It doesn't say substantially in India or partially in India. It says wholly. So what happened? There was a lot of room for tax evasion was happening, because people were still, using the low tax jurisdictions, which are basically tax havens. Say, like, for example, even you take UAE, they don't have a corporate tax. So set up a company in UAE, but everything will be controlled by a person sitting in India. And Singapore will be used, UAE will be used as a tool to either, use Hawala transaction or convert your black into white, and to dodge taxes, keep it there. And many of these so-called tax havens also mushroomed, like Mauritius, Singapore, Ireland, etc. So people were using those, and they were trying to get away saying wholly. So they were trying to have an arrangement in such a manner that no, there's one employee sitting there, one board member is there. And we had a lot of cases happening in India. What does a control mean? What does a management mean? These are all very subjective terms. Am I controlling you? Who's a management? Management means it's only CFO, CEO, COO, or only the board guys in the board who takes the decision. So, but yeah, this subjectivity still continues there. It is going to continue. But the bottom line is, this gave a lot of scope for tax evasion. So therefore, India moved in 2016 to a concept by Delhi called the place of effective management. Place of effective management, what does it mean? And also tell you what was the rationale for India. And India gave a reason for as well, when they introduced this concept of a I had a slide. Okay, I'll anyways, I think got missed. Now, just wanted to share, what was the rationale. So, Indian government came out specifically as to what was the reason for them to come out with this arrangement. And they had mentioned it. Anyway, when I send the revise, I'll share the. I put an exact press release as to why India moved to it. I thought that will give you a better picture as to rationale for changing it, which I read. It was there in the Finance Act 2015. It said that, due to the requirement that whole of control and management should be situated in India, and that too for whole of the year. So it says wholly, and that too whole of the year. The condition had been rendered practically inapplicable. A company could easily avoid becoming a resident by simply holding a board meeting outside India. This facilitated in creation of shell companies. You would have heard about sham entities. This created a facility of shell companies which are incorporated outside but controlled in India. So therefore, the concept of POEM was introduced, which is an internationally recognized concept for determining residence of a company incorporated in a foreign jurisdiction. Now, as I mentioned already to you, the POEM concept was very familiar in India for the fact that, familiar already because many of our tax treaties had this place of effective management already in our tax treaties. So in tax treaties, a resident of a company is determined either by incorporation or by a place of effective management. US is very particular that they always go by incorporation theory. You see in all US tax treaties, they only refer to incorporation. They never talk about place of management, but all other countries, including India and European countries, are okay to go beyond incorporation and say, hey, look, what is the substance? Just because they are set up in UAE, just because they are set up in Mauritius, but if everything is happening controlled by a person sitting in India, who's a who literally plays the key, and that foreign company is just a puppet, then the residential status should go to the country where the guys who are taking the major decisions are there. So that's how the place of effective management concept came about. Place of effective management means, so this is an exhaustive definition, means a place where key management and commercial decisions that are necessary for conduct of the business of an entity as a whole are in substance made. So essentially, if I am a UAE company and the management and commercial decisions that are necessary for conducting the business of UAE company are in substance made in India, the UAE company will become a tax resident of India, just like any other Indian company. So such ramifications is this, and a very, very significant tool for tax authorities in avoiding money laundering, shell company creation, moving the money to tax havens. So place of effective management will play a vital role. Just look at this example before your screen. XYZ Limited, an Indian company, sets up a subsidiary ABC in Mauritius. So there's an Indian company which has set up a subsidiary in Mauritius. Now ABC Mauritius is registered by a law firm, MF. I don't know if you all aware, the Panama paper leak, the Mossack Fonseca. There's a very interesting, for those, who watch a lot of stuff in OTT. There's a very good OTT, you have a good reason to watch a Netflix movie. The movie called The Laundromat, which is about the Panama paper leak, basically tax siphoning and, setting up these shell companies. A law firm called Mossack Fonseca was setting up these entities in Caribbean islands, tax havens. It's a very interesting movie, to watch. But anyways, you should do it when you get time. As I said, good reason for you to watch Netflix for a change. Having said that, coming back to the poem concept. So now a lot of these tax havens, the providers like law firms and there's some service providers who help you just set up a company. So just as in this case, ABC Mauritius office is registered by a law firm, MF, and ABC registered office is also in the same premises. So you would have seen this in a lot of documentaries in YouTube as well. There'll be one single building which will be a registered office for not even just a small room. That's what it's called. Sometimes these shell entities, sham entities are also called letterbox entities. So they will have various letterboxes, but there will only be a small premises or one building which will have no offices, only letterboxes. Basically, that building will act as a registered office for hundreds of entities. This is how shell entities are created for tax evasion or avoidance. So now, in this question, in this illustration, if you see, the law firm's office is where ABC Mauritius is, and there are no employees. Naturally, there are no employees in Mauritius except for a receptionist, and it is fully managed by Mr. X from Gujarat. Now, ABC Mauritius, for the financial year ended 31st March 2022, has a profit of Indian equivalent. For a moment, I have converted into INR. Indian equivalent 75 crores with a turnover of 100 crores. The Indian tax authorities wishes to tax ABC Mauritius in India. Is it possible? So this illustration reflects exactly the reason why the Indian government introduced the concept of poem. If not for the poem concept, this would not be a tax resident in India because this is a Mauritius company. We are talking about ABC Mauritius. But ABC Mauritius has no employees except for a receptionist, and it is fully managed by a person sitting from Gujarat. And there's a profit of around 75 crores made. So place of effective management concept is essentially now what it tries to do is have a non-Indian company, which is ABC Mauritius, to be treated as a tax resident of India by invoking the place of effective management concept. So this is in nutshell what the poem tries to address. Now, one small aspect, I could have stopped it without any numbers. Now, the reason for me giving these numbers, 75 crores, turnover of 100 crores, is the income tax list, the CBDT guidelines gives a benefit of 50 crores. So if you have a turnover of 50 crores, then you can get away. So there's a threshold, monetary threshold, turnover of 50 crores and less. So if ABC Mauritius, in the given facts, very clearly it shows that poem is in India because everything is controlled by Mr. X from Gujarat. But however, if the turnover is less than 50 crores, it is exempted, monetary threshold of 50 crores. In our given case, however, turnover is 100 crores. So place of effective management will attract. We will go into the nuances further. What are the other guidelines? How do you say it if it is managed by Mr. X from Gujarat? What if Mr. X keeps traveling to Mauritius every quarterly takes decision? Or what if the receptionist takes all the decisions? There are various, as I mentioned to you, these are all very subjective elements. So there are some guidelines that the CBDT has issued. We will have a look at it. But effectively, the point I want to dwell, two things. One, a foreign company can become an Indian tax resident, provided if its place of effective management is in India. And the second aspect that you need to bear in mind is the threshold aspect. If the threshold is, that is the turnover of the foreign company is less than 50 crores, it is out of the poem ambit. Now, okay. So what if it's become a tax resident? Huge. If it becomes a tax resident, a foreign company becoming a tax resident in India, what are the consequences? The consequences are pretty serious. What? The worldwide income is taxable at 40%. You may wonder, look, only foreign companies are taxed at 40%. If it becomes a tax resident in India, shouldn't it get the benefit of 25%? Should it not get benefit of 22%, 15%? No. The axis, you are a tax resident, but your rate will still continue to be at 40%. So imagine all ABC Mauritius profit will be taxed in India at a whopping 40%. Not only that, transfer pricing provisions will attract. There may be treaty benefits. Normally, US denies treaty benefit on account of dual residencies. So you may lose treaty benefit. And there may also be withholding provisions. So where, since you have become a tax resident, then you may have to withhold the taxes in India. Then you need to file return of income, TDS return, equalization levy, which we are going to see fag end of the session, not today, in the next week. Interest and penalty, if poem is determined during tax scrutiny, huge interest and penalty. And if you don't withhold taxes, you can also become an assessee in default under section 201. So net, it's a disaster if you become a tax resident in India by virtue of the poem. Now let's dive into some technical aspects to it. As I mentioned to you, it's a very broad subjective concept. So there are some guidelines that is provided by the legislation. We'll try to understand that. Now, just to break up the poem definition, which we looked at it some time back, your key management and commercial decisions, key management and commercial decisions that are necessary for the conduct of business of an entity as a whole are in substance made. So in India, you should take key management, key first, it should be a key decision. So which means it cannot be a routine, it should be key, it should be a management decision, it should be a commercial and in substance made. So it doesn't talk about wholly, it talks about substantially. So substantially, the key management commercial decisions should be made in India in order to become taxable in India. Now, being a very subjective element, because we saw key, management, commercial, very difficult to define them. So the government came out with a guideline, detailed circular in 2017, giving out a mechanism as to when can a POEM trigger for a foreign company. We look into that guidelines as we move along. But just, few examples which will help to understand the guidelines better. So I've given few illustrations which will help you to understand the guidelines better as we move along. Also to establish the fact that how subjective these can be. When I mean subjective, there is no clear answer. You can't have a guideline that can be, a waterproof saying, oh, look, tick, tick, tick. There's no check the box here. You have to go into the facts and understand. For example, let's see the first one. XYZ Limited is set up in Karachi, Pakistan, managed by Mr. Yam from India. The turnover is equivalent to INR 35 crores. So therefore, the tax authorities want to classify the Pakistani entity as a tax resident of India, invoking POEM. No, not possible. Because you have to, the threshold should cross 50 crores turnover threshold of the foreign company. Now, with regards to the second illustration scenario, Mrs. 123 Limited, set up in Jaffna, Sri Lanka, is effectively managed by Mr. Murali from Chennai, India, during financial year 1920. This was for financial, please keep in mind, financial year 1920. And accordingly, 123 Sri Lanka was held to be a tax resident in India for assessment year 2021. Let's assume the other things of, that is, turnover is more than 50 crores, the guidelines are followed. So it was held to be tax resident in India for AY 2020-2021. Now, Mr. Murali migrated to Jaffna during April 2020. Now, the AO for the period assessment year 2020-23 has classified 123 Sri Lanka as a tax resident based on its past history. So, you were a tax resident in assessment year 2020-2021. So, therefore, for assessment year 2022-2023 also, I'm going to treat you as a tax resident. Consistency. No, you cannot do that. So that's again, you have to look every year the tax residency. The Supreme Court famous Radhaswamy Satsang. So each year you have to look at the guidelines, the factors, the indicators. 1 year I may have 70 crores turnover. Next year I may have only 30 crores turnover. So year 2, I will not become a tax resident. Year 3, 80 crores. And other things satisfied, I may become a tax resident. So year on year, you need to look at, and you also have to look at the facts. If you look at here also, Murli migrated to Jaffna during April 2020. So which means he is still not in Chennai, India. So all the more baseless to classify 1, 2, 3 Sri Lanka as a tax resident. So that's why I said the facts become very important. Now, on the third aspect, ABC GmbH, set up in Germany by Mr. S from India. Mr. S visits Germany every quarterly for a week to foresee and supervise the ABC GmbH operations, the ABC German operations. The AO decides to treat ABC GmbH as a tax resident of India, invoking POEM principles. Is it valid? I'll finish the next part also. Assuming the above question, Mr. S, instead of visiting quarterly, spends 3 full months in a year continuously there in Germany. So the fact pattern here is Mr. X controls, supervises everything who is an Indian resident. But if you look, the facts also says he keeps traveling to Germany every quarterly for a week. And the next second part of the variation also says, if not, let's take a situation where he visits quarterly. That instead of visiting quarterly, he spends 3 full months. From Jan to March, I'll be in Germany and finish off all my stuff, and the rest of the 9 months I'll spend in India. So now the point here is, all it essentially establishes that you cannot blindly, just because a resident is managing the show, or it is a wholly owned subsidiary of an Indian company, one cannot take blanket or a broad view. You have to look at various factors, that is year-to-year basis, look at the turnover. Facts and circumstances are very, very relevant. For example, he goes, Mr. S goes to Germany, and during his visit in Germany, he may be taking the key commercial and management decisions. It doesn't matter whether he goes quarterly or whether it goes 3 months. You have to look at over a period of time. You can't look at on 31st March, or you can't look at on 30th September, or you can't look at on 1st April. You have to look overall macro view of, or a bird's eye view, April to March, what happened. So there are a lot of aspects that one needs to be look into it. And there can also be POEM in India and outside India. So 6 months in India, 6 months outside India possible. In that case, the guideline says the POEM shall be presumed to be India if it is mainly or predominantly India. So which again goes to the subject, how to find out which country where the predominant factor was there. And as I mentioned to you, it has to be looked over a period of time. So all you need to keep in mind is the turnover factor and where the key commercial decisions are made. But having said that, there are no straitjacket formula to it. It can be subjective. So that is why if you look, the government came out with some guidelines in terms of identifying gave more clarity in order to determining the POEM because of the subjectivity. So we'll just have a look at that. That may be relevant from an exam standpoint as well. So now, what does the CBDT says is, first determination factor is determination of POEM is based on the following categorization of foreign companies. That is, first you need to look out is whether does it perform its business, that is whether it has an active business outside India. This is very important. ABOI, we all love acronyms, they're acromaniacs. So ABOI, active business outside India. So first you need to see whether the foreign income has active business outside India. If it has active business outside India, then we can conclude that the POEM is outside India, provided majority of the board meetings are held outside India. But having said that, one more disclaimer also, mere having a board meeting outside India will also not be sufficient. So which means today traveling is quite easy. Gone are those days where travel is a luxury. Today I can just take a flight every quarterly, go finish the board meeting in the morning and come back. So what is very important, it's not the board, that is a de jure. You should also look at a de facto, that is who really takes the decision. Is it somebody, an Indian parent that is taking the decision, or somebody sitting in India and taking decision? Has to be looked into it. So I'll come to this part. That is, what if your active business outside India test is failed, which means you have an active business in India, then what are the aspects? But before that, we will see what is active business outside India. Now, as the name says, active business outside India. So my active business should be outside India, in line with me being a foreign company. A company shall be said to be engaged in active business outside India if passive income is not more than 50% of its total income. That is, the foreign incomes, passive income should not be more than 50% of its total income. I'll tell you what a passive income is. And 50% of its, less than 50% of its total assets should be situated in India. Less than 50% of total number of employees are situated in India or are resident in India. The payroll expenses on such employees is 50% less than of its total. So you can see the foreign company should have less than 50% of its total assets in India, less than 50% of its total employees situated in India, less than 50% of its total payroll expenses for those employees in India, and passive income should also be less than, that is, it should not be more than 50%. So if all these four conditions cumulatively I should satisfy, all the four conditions I must cumulatively satisfy. My passive income should not be more than 50%. My assets, that is the foreign company, when I mean the foreign company, the foreign company should have less than 50% of its total assets situated in India, less than 50% of total number of employees are situated in India, and the payroll expenses should be less than 50%. Now, only one aspect I want to touch, and then we'll take an example for you to better appreciate this. 50% of total assets, total number of employees. I'll not get into the nuances of it. The broad principle is you need to understand that you should have less than 50% total assets, foreign company less than 50% of the employees situated in India. Passive income should also be less than 50% of its total income, which means it should have more active income. Now, what is, as you all know, normally active incomes are business incomes. Passive incomes are your interest, royalty, dividends are your passive income. You go work as a CA, as a lawyer, you earn fees, those are your active incomes. From that fees, I invest in FD, I get an interest, that's a passive income. I put it in a property, the property fetches rent, that is a passive income. Invest in shares, get dividends, that is a passive income. As you all know, active, passive. Now, income tax for POEM defines what a passive income is. Slightly interesting. Because it has this royalty, dividend, capital gains, interest or rental. Your conventional passive incomes are included. But what is very surprising and may have a far-reaching implication is income from transactions where both the purchase and sale of goods is from or to its associated enterprises. So basically, this is actually nothing but an active income in all real sense. But they are classifying it as a passive income and saying if there is any transaction that is happening between your associated enterprises. Purchase and sales from your associated enterprises, and you get an income from that transactions where both, this is very important, income from transactions where both the purchase and the sale. So it's not about me buying from an associated enterprise and selling to a third party will be included. I buy from a associated enterprise and sell to another associated enterprise. Then in that case, they are classifying it as passive income, which on a more prudent basis makes a lot of sense. All they are trying to ensure you that you are not set up in a tax haven to avoid taxes by just trying to act as a group company, shifting of money. So therefore they say if that foreign company has income through transactions of both purchase and sale. So there may be a question where it will only say income from transactions where sale was made to an associated price. Purchase would have been from a third party. Be very careful. The examiner is trying to trick you there. So in order to include as passive income, both the purchase and sale should be from associated enterprise. If that is there, then it becomes a passive income. So you will compute and see if it is less than 50%, and all other conditions, 50% of assets, 50% of payroll, and employees situated in India should also be less than 50%. So if that gets, your active business of India test will determine based on that. As you may see graphically put here, a company is said to be engaged in ABOI, active business outside India, if it fulfills the cumulative conditions. Cumulatively, I should satisfy. Passive income is 50% less. For the purpose of passive income, apart from your conventional passive incomes of rent, royalty, interest, capital gains, dividends, you also have transactions of purchase and sale within your associated enterprise will also be considered as passive income. Less than 50% of total assets situated in India. Less than 50% of total number of employees are situated in India. And payroll expenses incurred on such employees are also less than 50%. If all these conditions are satisfied, then it is deemed to be an active business outside India. Just have a look at this ABOA condition. So to better understand the ABOI, let's look at this specific example. Singtel is a company incorporated in Singapore, and 55% of its shares are held by Godavari Private Limited, an Indian company. Singtel Limited has its presence in India also. Now, the detail relating to Singtel for previous year 2021-22 are under fixed assets at depreciated value for tax purposes, India 120, Singapore 80, the intangible assets 50, 200, other assets value as per books of accounts 40, 120. This is income from trading operations. Income from trading operations 25 crores in India, 50 crores in Singapore. The above figure includes income from transactions where purchase are from associated enterprise and sales are to unrelated parties. So this will not be included as a passive income. Income from transactions where sales are to associated enterprise and purchases are from unrelated parties. This will also not be included. Income from transactions where both purchase and sales are from to associated. So this will be considered as a passive income. Now they have also given additional information. Interest and dividend from investments, 20 crores in 15. Number of employees they've given in the respective countries, 70 and 90. Payroll expenses, 8 and 12. So essentially what you need to do is find the active business. Are they satisfying the active business outside India? First, that will be the determination. This is the residential status. In order to determine the foreign company, is to first determine where the poem is, whether the poem is in India. Now, the criteria that is given by the CBDT, first see the business test. That is, see whether it has, what is the condition when it comes to active business outside India test. 50% of passive income, it should not be more than 50%, less than 50% total assets. This we have seen. Now, let's try to find out the passive income of Singtel should not be more than the first condition. The passive income should not be more than 50% of its total income. Now, how to compute the passive income? So you can take all the passive incomes, that is royalty, dividend, capital gains, interest, and income from transactions where both purchase and sale. You can always please have a look at this tonight. I'm just, since it's already there, I'm only trying to explain the concept. You can have a look at it, Aram say. Now that 15 crores, if you look at the question here, go back to question, it says income from transactions where both purchase and sales are to and from associate enterprise. So that will be included as a passive income. That is 5 crores in India and 10 crores in Singapore. So this will be included in 15 crores. And they have other passive income of interest and dividend from investment. It comes to 35 crores. So my percentage of passive income to total income will be 50 crores divided by 110 crores. So which is 45.45%. So since passive income is less than 50%, first condition is satisfied. Now I have to go and see whether I satisfy the condition 2. Should have less than 50% of total assets situated in India. What is the value of total assets of Singtel during the previous year 21-22? 210 crores in India, 400 crores in Singapore. You may have this here. $210 crores in India, 400 crores in Singapore. You can just cross-verify with the number. So my percentage of assets situated in India is my total asset works out only 35%. So I satisfy condition 2 as well. Now when it comes to condition 3, my number of employees situated should be 50% of total number of employees situated in India. So total number of employees is 70. Total number of employees of Singtel is both India and Singapore put together 160, which is also comes out to 44%. Similarly, you look at the payroll expenses. Total payroll expense of employee 8 crores. I'm not getting into the number part. I'm only trying to, make you understand the concept. So if you put the math, it works out to less than 50%. So if you look all the cumulative 4 conditions in order to become an active business outside India. So now since these are all satisfied, this becomes an active business outside India. So once you satisfy the ABOI, active business outside India, then it is presumed that the board meetings are outside India, the majority. So you have to give a note. It is presumed that if the majority of the board meetings are held outside India, then it automatically becomes a non-resident. It will not become a Indian company. So this is precisely the point which I wanted to stress upon. Now, another aspect also is what happens if I don't, that is, if I have more than 50%, what will be the scenario? Will I then automatically will I be presumed that there is a poem in India? No. Just because you satisfy doesn't mean that poem gets. So the ABO is only a gateway. So if you are able to prove that there's an active business outside India, then all you need to do is just find out where the board meetings are held, and then you can remain. But let's assume you have more than 50% of passive income, more than 50% of assets in India. Then again, other subjective exercises will get on to. That is, you need to identify who makes the decision, from where does he make the decision, and are these commercial decisions, are these management? So don't worry. I don't think at your exam level they will get into such aspects because they are very, very subjective. Because there are a lot of guidelines, parameters which CBDT has given. If the board meetings are happening virtually, then what will happen? In COVID times, that was one of the issues. Poem was worried because a lot of foreign companies board meeting happened virtually, and many of these directors were sitting in India. So these kind of issues can. But anyway, for all you need to know is you will get into multiple such yardsticks or measurements, and only finally they will determine as to whether, as you see, location where the board of directors meet and make decisions. And again, who is the senior management? They have given indications: managing director, CEO. I will not get into all these nuances, but you must be aware about this. Location of head office, very essential, especially in the digital world. And as tax advisors in the future, that we need to be very mindful about this, because a lot of people today travel, work, sit from India, but then work for a US company or Singapore company. So one should be extremely careful. Modern technology really made it possible. So first, you need to watch out for active business outside India. And if all the conditions of ABOA is satisfied, then if the board meetings are happening outside India, it is presumed that there is no poem. If you fail to satisfy ABOA, that is more than 50%, then you need to get into various other yardsticks. Then you go detailed. Okay, where are the directors? Where did this meeting happen, etc., etc. Let's quickly also run through this example to better understand the concept. If you see example 1 in the material, company A Co is a sourcing entity incorporated in country X and is 100% subsidiary of an Indian company. The warehouses and stock in them are the only assets of the company and are located in country X. All employees of the company are also in country X. The average income-wise breakup of the company for 3 years is 30% of income. Everything seems to be less than 50%. 30%, 30%, 10% interest. So again, 30 plus 10, passive income will only come to 40%. If you look at this, passive income is 40%. Just go through the facts, you'll understand. So effectively, they're saying, I satisfy the test of active business outside India, and therefore the company is said to be engaged in active business outside India. Example 2, example 3, please have a look at it more or less. Whatever we've discussed, they have tried to explain the principle to that effect. Now, just one another point, on this particular illustration, which of course I've already explained this, but I thought will re-emphasize again. Just because my active business outside India test is satisfied doesn't mean that I can escape POEM. Look at this example. ABC, a UK subsidiary of an Indian company, has active business outside India. That is, it has satisfied all those 4 conditions: passive income, assets, employee, payroll. However, on further scrutiny, it was found that the board of ABC Limited, the UK board, does not take any major decision, and it is the managing director of the Indian company who takes the major decisions. The AO in this regards treats ABC Limited as tax resident of India. The ABC Limited contends that, the UK Limited contends that it satisfies the condition of active business outside India, and therefore POEM won't trigger in India. Unfortunately, this is not right. Just because you satisfy ABOI doesn't mean that the gate is closed for you. The tax authorities can further probe and find out who really takes the key commercial and management decision. And if they find out that the board in UK is just a namesake, that is de jure, but the de facto decisions are being, factually the decisions are being taken by the board of Indian company or somebody from India, then POEM will still trigger for the UK entity. Non-ABOI trust, I've already touched upon. If you don't satisfy the conditions, then next again you have to look at where the location, technology, and other factors. In fact, there are also some treaty which says you have to see where the accounting registers are maintained. Many of these shell companies, if you see, accounting will be happening from India. So if the accounting records and major records are kept in India, that is also a valid giveaway or a point for the tax authorities to contend that the POEM is in India. Now, one very, very crucial aspect, we have seen the yardstick, what are the parameters to classify a foreign company as a tax resident by virtue of POEM guidelines. Now look at this particular question. For assessment year 22-23, the AO is satisfied that Messrs. ABC Limited, registered in Nigeria, is a tax resident in India, tax resident of India under the POEM guidelines. Now it has issued a demand notice of 35 crores to ABC Limited saying, you are a tax resident of India, come and pay because under the POEM guidelines, you satisfy. You failed the active business out India test. We find out that all the decisions are taken from India. So therefore, ABC Limited is a tax resident in India. Accordingly, assessment computation was made and a demand notice of 35 crores was sent. Is the action of the AO valid? Now, this is the last procedural aspect that you need to keep in mind. As you would have seen all these while when I had discussed, lot of subjective elements came in. De facto, who takes the decision finally? It's not the board. Key commercial. What is a key decision? What is a commercial decision? What is a management decision? Who takes it? Does a CFO is a key? So there are a lot of subjective elements, and when you go factually, practically look into things, you'll find out a lot of very interesting elements which are very operational driven. So now what the fear taxpayers had was being subjective. So when anything is subjective, it always have two sides. You will try to argue saying, no, this decision was taken during my visit to UAE, during my visit to Mauritius. If I am the tax authority, I will say, no, all those visits are just for eyewash. You don't satisfy the ABOI. And I find out that look at your email trails. I can see that you have approved this expense, you have approved that, you have paid. So anyway, you'll always come with various justification. Now, what they have done is, bottom line, an AO cannot just like that issue a demand if he's convinced. This will go to a panel which consists of income tax officers. Unlike your GAR panel, your GAAR, General Anti-Avoidance Rule panel, which has outsiders also, other than tax authorities. For POEM, a constituted panel consisting of 3 tax officers will go through all the facts, will go through the report of AO, will go through the report submitted by the as taxpayer, will also listen to the taxpayer. They will finally decide as to whether it is a POEM or not. So one more filter, the final filter, it's not the AO who will take the decision. It's a panel, an approving panel, where this issue will have to be taken up by the AO to the panel, and is a panel consisting of 3 officers. If they decide that this is a POEM or not a POEM. So therefore, action of the AO, is it valid? No. This is not valid because he cannot issue a demand notice. If he is satisfied that ABC is coming a POEM, then he should put forth all the reasoning to a POEM panel, and then the POEM panel will give an order saying, yes, we determine that the place of effective management in India, and pursuant to which the AO can initiate a demand notice. I just have one last question that is part of the problems which I have also uploaded. Quickly, we'll look at that, and then question number 2. UAE company was a company incorporated and registered in UAE with the object of holding investments. From out of 100 shares issued by the company, 900 shares were held by Mr. Shah, a resident in India, and balance 100 shares were held by Mr. Rafiq, a UAE resident. Both the shareholders were directors of the company, while the UAE resident was the chairman director. There was no employee of the company in UAE. Some of the board meetings were attended by telephonic conversations or video conferencing process. The company had made investment by grant of loan to an Indian business group owned by relatives of Mr. Shah. So this does, of course, there are no computation about active business outside India, but those numbers should be given. But otherwise, prima facie, it looks like UAE does not have a substance, and the key decisions and commercial aspects seems to be taken from India. So you have to give the ABOI test, and assuming that the active business outside India test, you can take a call whether it's satisfied or failed. Irrespective of it, then you go to the next stage, that is to see who has taken the decisions, from where those decisions are taken, and how significant those are they key commercial management. From the facts, it appears that all the meetings were attended by telephonic conversation or video conferencing, which means Mr. Shah hasn't traveled, and it looks like relatives of Shah. So everything seems to be controlled, or everything seems to be effectively managed from India. So this is broadly kind of question that one can also expect. So just to sum up, very essential for a foreign company that can become a tax resident in India. And we also saw what are the consequences of becoming a tax resident in India. And more importantly, how do you determine the place of effective management? So one should keep all those conditions and all those things in mind. Just because a foreign company is incorporated or set up in foreign does not mean that it automatically becomes a non-resident. It may also become a resident if it is effectively managed in India, for which the guidelines, thresholds, 50 crores, and all those things one would have to ban. So, if you have any questions on poem, please feel to put it. Having looked at, our idea was how to tax non-residents. That is what we are going to go in the next segment. But then I thought it is important for us to look at the residential status of a corporate, especially of a foreign company. And having seen that a flavor of how a foreign company can be a tax resident in India through POEM, now we will move on to the source aspect. That is, how do you tax a non-resident in India? And what are the incomes in which you can tax the non-resident? So what I will do is we will take a 10-minute break, maybe 7:45. We will resume again. See you all at 7:45. I did see a few questions on the poem. Just one, somebody had asked, somebody had mentioned that, why not any subsidiary in India, why not classify them? Any subsidiary of an Indian company, why not classify them as a poem? Just because, that's what I said, just because you have a subsidiary doesn't mean that you are the Indian parent, doesn't mean that all the subsidiaries are effectively managed from India. So there's something called shareholders activity. Shareholders influence is allowed. As a shareholder, you can take decisions, you ensure that your investments doesn't get eroded, demuted. But if you start getting into let's assume I have Bharti Airtel shares. If you start getting into every aspect of Bharti Airtel, I'm not just a shareholder. I'm more than to it. So shareholders influence a lot. Again, as I mentioned, not all subsidiaries of Indian company cannot be poem. Each separate entity, and they also have their own people who are doing it. So you cannot paint everybody with the same brush. So that's why you have to look at various other factors and cannot, benchmark saying, okay, you are a subsidiary of Indian company, so there's a poem. Not necessarily. You have to go deep and find whether at all are the subsidiaries, overseas subsidiaries, is being commercial decision management, everything is done from India. One need to look at it. Now, if not poem, Namita raised the point, if not poem, then why as it is, then also can it be taxed as wholly managed? No, the wholly managed was until 2015. Post 2015, the poem replaced the control and wholly managed. So therefore, that is not effective. You have to only look from 2015 onwards. You have to look only the poem criteria. Correct, Namita. It's not stick to words. That's why in the act, if you see, there not be much when it comes to poem. Only poem definition would have been given. But there's a CBDT circular guideline which gives guidelines as to what are the parameters. And again, as I mentioned to you, it's a very subjective element, and that's why even an approving panel is required before any decisions is being taken on poem. So with this, having looked at tax residency for foreign company, now move on to the very important point on taxability of non-residents. As already, when I begin, I mentioned that for a resident, your worldwide income is taxable because the Indian constitution permit extraterritorial, not necessarily incomes earned in India, but as long as there's an effect or impact to India, nexus with India, the residency will be a nexus. That is enough. 180 days and above is a nexus. So therefore, your global income is taxable. But when it comes to non-residents, that is not the case. Non-residents have to have some sort of a territorial nexus or an economic nexus with a foreign country in order to get that income tax in the source jurisdiction. That's why it's called source, because normally non-residents won't pay. If you're a resident, you will pay in your home country, but can a resident pay in a source country? So from an India standpoint, let's take India as a source country. And when will non-residents be taxed? Non-residents will be taxed only if it's an India-sourced income. For non-residents, India-sourced income will be taxable under the Income Tax Act. Now, what are the categories of income? Already we've seen income under Section 5, Clause 2, income received or deemed to be received in India. Income received, you all know what it is. You get an income, gets taxed. Deemed to be received is there in Section 7. Income accruing or arising in India. Yes, there is no clear answer to it, but Supreme Court have come and say, have tried to classify what is accrual of income. But as long as you're able to establish that income accrued, the origin point is in India, straightforward. We also have one more element called deemed to accrue or arise in India. Now, this was very essential for us, the deemed to accrue and arise in India, in order for us to have the taxing rights. Because prior to deemed to accrue arise in India, the deemed to accrue arise in India provisions, which we will see now, is largely inspired from the tax treaties. So, what happened when India started to enter tax treaties with developed economies? They broke down into royalties or fees for technical services or for any income. The opponent party, the non-resident, will take a stand that look, these are sourced in my home country. These are not accruing in India. These are accruing in my home country. So therefore, I will not pay any tax. So to counter that, India introduced the fiction by virtue of Section 9, that is income deemed to accrue or arise in India. So therefore, by virtue of Section 9, these incomes which we are going to see now will deem to accrue arise in India. Whether or not they accrue arise in India, without getting into it, deem to. So if for a moment it is accruing or arising in India, straight away accruing arising in India, not a problem. I don't need to go to Section 9. Section 5 gives me a right to tax the non-residents. But if there is a doubt whether this really accrues or arises in India, then I go to Section 9 to see whether does it deem to be accrue or arise in India. If that is the case, then it becomes taxable in India for the non-residents. Please note, before I go into the technical aspects, we are looking at the domestic tax law, friend. You also have the tax treaties, which will follow later. So first look at domestic law, then go to, that's how the order should be. So when we touch upon double tax relief chapter, I will dwell further on the treaty nuances. But we cannot stop only with domestic law. That's the point. Start with domestic law, then go to treaty law, and then determine. Because sometimes treaty also says, it may be taxable in India, but India has given up its right for the home country to tax. So these are some nuances you will get in double tax treaty for elimination of double taxation. Now, coming back to domestic law on taxability of non-resident, Section 9, which is a very important section on the source, tells what are the incomes that deemed to accrue or arise in India. Section 9, Clause 1, Subclause 1, all income accruing or arising, whether directly or indirectly, through or from any business connection. This is 911. We have 91 subclause 2, subclause 3, subclause 4, up to subclause 8. We look into it, all very relevant. 8 is a new addition, but nevertheless, we'll quickly look at the first one and we'll go deep into each of the classes of income. All income accruing or arising, whether directly or indirectly, through or from any business connection in India. So if there is an income accruing arising directly or indirectly from any business connection in India, then it is deemed to accrue arise in India. Through or from any property in India, through or from any asset or source of income in India, through the transfer of a capital asset situated in India. So 9.1 subclause 1, 9 clause 1 subclause 1 says any business connection in India, any property in India, that is income accruing or arising. Through or from, through any asset, from any asset, through any source, from any source, through the transfer of a capital asset situated. So in these situations, income accrues or arises under Section 9. Now this is 911. Moving further, 91 clause 2 talks about salary. I've not mentioned here, but yeah, that's a 912 talks about salary payment being accrued in India. We'll look into it when I come to 912. And 913 talks about basically for simple provision to tax diplomats who are working in Indian embassy, but they are working in outside India. So their performance of work, everything is rendered outside India. So one may have a doubt as to whether that incomes are accrued or arising. They have been deemed to accrue in India because the Indian government is paying that. So that's why 913 specifically legalizes any income of salary received by diplomats of Indian diplomats who are working outside in various embassies. And 914 talks about dividend paid by an Indian company outside India. So any Indian company making payment dividend to a foreign shareholder, the foreign shareholder cannot say it does not accrue or arise in India because I made the investment sitting from my home country. So it only accrues or arises. No. India clarifies if the dividend is paid by an Indian company, then it is deemed to accrue in India. Similarly, income by way of interest paid to a non-resident by government or by resident or anybody relating to India, then that will be income. We'll get into the nuances later. Very important clauses that we normally come across quite often in this modern age is royalty payments and fees for technical services. Very important because fees for technical services also encompasses professional services. And as you all know, India is one of the leading service providers as well as service recipient. So therefore, we do take a lot of professional services. We also give. So therefore, it is very important. So for any non-resident which is receiving a technical service fee, will become deemed to accrue or arise in India. Example, let's assume I'm a law firm working out of Germany and I give an advice to an Indian client. Now the German lawyer will come and say, hey, look, I'm sitting in Germany and giving everything. Why should I pay tax in India? So section 919 clause 1 subclause 7 says it is deemed to accrue or arise in India. And then 918 was recently introduced, gift by a resident to non-resident. Now all these whiles, what happened, a resident used to give a gift to a non-resident, and then they will say it is not taxable because the receipt happened in a foreign state. So now they have tried to plug that also to avoid any tax siphoning or movement of money. If there's any gift by resident to non-resident, that is also deemed to accrue or arise in India. So broadly, what I was until now is trying to indicate what are the baskets or different kinds of income that comes under section 9. Now, having seen that, let's get into the first one. 911. If you recollect, it says all income accruing arising, whether directly through or from any business connection in India. So a non-resident, any income that accrues or arises to him directly or indirectly through or from any business connection in India. Now, I want you all to think in a first principle basis. Okay, for those who have already dealt, well and good. But otherwise, just let's you try to reignite, reset and then think fresh. All income accruing arising, whether directly or indirectly, through all these, you have to look from a non-resident standpoint, because we are concerned about non-residents taxation. If it is deemed to accrue or arise in India, then it will become taxed in India. So for a non-resident, any income that accrues or arises through or from any business connection in India. So what is this business connection? This looks to be again a very exhaustively termed terminology. I give you an example for just to easily appreciate. Mr. Grant Elliott, a New Zealand cricketer, for those who follow him, he has a bat manufacturing company. He gets orders from Shreyas Iyer, an Indian cricketer, to buy 10 bats. Now, the question is whether a business connection exists for Grant Elliott, because he does a business of bat manufacturing and selling. And Shreyas Iyer in India says, hey, Grant, give me 10 bats, ship it to my Bombay address. I'll make a payment to you. And then he ships it. So can I say there's a business connection for Grant and therefore the income that he gets is deemed to accrue or arise in India? This is one aspect. I'll answer it. Now, will your answer change if he gets every year order from 5 IPL franchise teams to supply 20 new cricket bats? So every year IPL, so 5 franchises, CSK, KKR, MI, they all say, okay, hey Grant, keep giving us, IPL season is about to begin, keep sending us 20 new bats. Now, will that create a business connection? Now, the point is, the concept of business connection is indeed very, very wild. When I mean wild, it is actually wide as well. Let's put another very crude example. An American decides to sell, soap bars to Sudarshan in Chennai. Now, that's this single isolated transaction. I thought, okay, nice soaps, fragrance. Okay, let me buy online. and I go buy. So does this mean that the American has a business connection in India? Does this mean me and the American have a business relationship, which the Act is trying to seek to tax because it is deemed to occur for the American? Now, unfortunately, we do not have a definition of business connection. But of course, now explanation 2 tries to says what business connection can also include. Explanation 2 to section 9 clause 1.1. I'll also display it there in the study material as well. That is an inclusive, so it goes over and above, but we do not have any proper exhaustive definition as such. Now, so for which the Supreme Court way back bailed out. It's a very landmark judgment in 1964 by R.D. Agarwal and Co., which is in front of your screen. The Supreme Court held, in that case, it was simple. 2 non-resident companies had engaged Mr. Agarwal to procure sales contracts in India. So Agarwal was a commission agent who will try to procure sale contracts for these 2 non-residents. Now, the department contended that there is a business connection existed between the non-resident companies and the Indian representative. But actually, if you see, the Indian representative role was only to identify potential customers, and then they will negotiate with the non-resident seller and accordingly finalize the contract, play the price. He was only doing a commissioning job. Now, you can ask why. So he was basically treated as a representative associate. That's the point. But anyways, the principle that Supreme Court looked at it is, look, you need to have a real and intimate relation. You can see that it should have a real and intimate relation. A real and intimate relation is very essential. And a mere stray or isolated transaction will not tantamount to being a business connection. So therefore, there has to be a real and intimate relation. That is very important. What they mean by real and intimate relation is the agent, that is, the agent in this case should be a real agent, meaning he should act for his principal, but merely, I'm doing an independent agency role and isolated transactions. All these things will not tantamount to me having a business connection. This is a very, very significant principle propounded by Supreme Court. So coming back to our example, again, just because stay as higher orders doesn't mean that there is a business connection with for Grant Elliott, the New Zealander in India. And similarly, just because every year the IPL franchisee teams buy, one cannot also say there is a real and intimate relation because these are stray, isolated transactions, not regular. He's not looking at Indian market to, okay, I need to get in Indian market, I need to find a lot of players. So the point is the volume of business is not enough at the Supreme Court to establish a business connection. There has to be more than that. The agents, these are all common, one-off transactions. I should have somebody who does basically trying to do, there's a difference between doing business with India and doing business in India. That is also the concept under the permanent establishment principles, which is almost equivalent to the business connection. You would have heard about this term PE quite often in your article stage. Comes as part of international tax treaties. The PE is basically that a foreign company, in domestic law, we use the term business connection, which is a more wider term. A PE, they have defined what could be the PEs. So a non-resident having a PE, a foreign company having a PE in India means they will have to pay tax on the business income. The permanent establishment or business connection, the underlying principle, please keep that in mind, is doing business in India vis-a-vis to doing business with India. So what is happening in Grant Elliott Shreyas Iyer case is nothing but doing business with India. It's not doing business in India. It's doing business with India. Doing business with India should not amount to a PE or a business connection. Now, having said that, what happened was after a few years, we had a amendment by virtue of explanation 2 to the Income Tax Act. This was largely to be in line with the tax treaty also. Now, this business connection, they try to define, or it says it is hereby declared that business connection shall include activities carried on through a person, that is through agent, involving. So now, imagine how a foreign company can do a business in India. It can either set up a subsidiary in India and cater to the Indian market, or have an agent and do a business in India. So therefore, now what explanation try to do is, wherever an agents are used or a third person are used to do activities, explanation 2 to section 9, clause 1, subclause 1, gave in 3 situations and said in these 3 situations, there is a possibility that the business connection exists. Now, if you look at the first one, the first point says, that is, if I have an agent for the non-resident in India, and that agent, the Indian agent, habitually exercises an authority to conclude contracts on behalf of the non-resident, or habitually conclude contracts. Is that in your study material as well? Maybe look at this point. So business connection, a person acting on behalf of the non-resident, that is basically agent, has an authority, has an habitually exercise in India an authority to conclude contracts on behalf of the non-resident. So to conclude contracts on behalf of the non-resident, habitually concludes contracts, or habitually plays the principal role leading to conclusion of contracts, and such contracts are in the name of the non-resident, or for transfer of the ownership or grant right to use property owned by that non-resident, or, this is very important, for the provision of services by that non-resident. So an agent who habitually exercises to conclude contracts, habitually conclude contracts, or habitually plays the principal role leading to conclusion of contracts, and such contracts are the name of non-resident, or even for provision of services by that non-resident. That is very significant. That is in line with the multilateral. I'll come to that. I'll give you an example also to understand the implications. So if these things are there, then essentially what will happen, that there establishes a business connection in India for the non-resident. The business connection will exist in non-resident. Now, the terms used, if you see, are habitual. Now, habitual, what is habit? Habit means regular. It becomes my habit. So therefore, regularly, which means there should be a serious, real relationship, intimate relationship. These are the aspects. So in line with the Supreme Court judgment and in line with many of the tax treaties, developments also, it does talk about any person who is acting as an agent, but if he has an authority to conclude contracts, who habitually is a very important factor here, then in that case, there is a business connection that exists. Now, this is one element to it. Now, moving on, there's also another inclusion in when a non-resident can have a business connection in India. In case where he has no such authority, but habitually maintains in India a stock of goods or merchandise from which he regularly delivers goods of the non-resident. So an Indian agent who habitually maintains in India a stock of goods from which he regularly. This is again go back to the fundamental, doing business in India. So what I do, Grant Elliott has an agent and says, hey, look, agent, Indian agent, say Sudarshan is the Indian agent. Sudarshan, I'm sending you 200 bats. Keep that in your godown, store, whatever. And then I'll tell you, then you dispose it off to CSK, dispose it off to Shreyas Iyer, dispose of whoever orders, you keep sending to that address. So what I will do, my role is only to maintain and I regularly deliver goods. So even in this scenario, there is a business connection that exists for the non-resident, because what he's trying to do here is he's trying to do business in India. He cannot say that no, I just have an agent, so I don't have business connection. No, he cannot say that. Now, last point, very again important point, habitually secures orders in India, mainly or wholly for the non-resident. So as an agent, even if I habitually secures orders in India, mainly or wholly for the non-resident, then even in such scenarios, I will be treated as a agent, meaning I have a business connection. When I mean the non-resident will have a, because these are the ways in which a lot of the non-resident companies were trying to evade the Indian, saying, no, all these sources are outside India. That is the contract I enter with the customers. So what they will do is they'll enter contract with the customers, but then they will have some independent agent or an agent, I won't say independent, have an agent who habitually maintains stock, who habitually secures orders for him. So in that scenario, the government says, no, you have a business connection in India. So therefore, this was recent developments, especially in light of the lot of in countries these were happening, where they were avoiding permanent establishment or business connection, especially foreign companies, through these agents. So that's why in the BEPS multilateral instrument or in tax treaties, amendments were made. Now, what happens if it becomes a business connection? If a business connection gets established, then under the Indian Domestic Law, Section 9, Clause 1, Subclause 1, there is a deemed to occur in India. So once it is deemed to occur in India, then I will have to attribute that the non-resident should have to attribute certain amount of income to India and pay taxes in India, file the return of income. So basically what India says is, you are effectively doing business in India and therefore please pay some taxes. We deserve it because you are doing business in India. India is the market economy here. So when you are trying to make revenue from India, pay some sort of share for India also. This is exactly now what is happening at the global level for digital companies like Facebook, Google, Amazon. What happens is, India has the largest number of users of all these technological platforms, but then we don't get our money because they sell our data to all, and then they make money, and then all these money taxes are either being paid in US or in Ireland, because Ireland is a tax haven for US. And as a market economy, because India believes it's not only the demand, it's not only the supply, it's also the demand. Both has to be there. Just because you can supply, unless you have a demand, where will you supply? So you need to have a demand. And yeah, it becomes political because countries don't want to share their taxing rights. So US says, no. And all these US companies will lobby. Look, I'll pay you only. Please ask India. You go use your influence. Anyway, this is a larger picture. So the bottom line is, by virtue of business connection, you get the foreign company to pay taxes in India because there's a deemed to accrual or arise in India. So just to complete this circle on business connection, this is akin to more or less similar to a permanent establishment concept. In fact, a permanent establishment concept in tax treaty, in fact, gives you specifically, for example, a non-resident has an office, a fixed place of business in India, which is at his disposal, and he has it for certain duration, then there is a permanent establishment. So permanent establishment is a internationally jargonized word used by all countries. You put a Desi version to it is nothing but business connection. Now, where there are tax treaties, permanent establishment concept will obviously, because your permanent what is a PE? Similar to how section 9 clause 1 subclause 1 explains, explanation 2 explains what a business connection could be. PE is defined in the tax treaties. So, and let me tell you, PE is defined in a less narrow manner compared to business connection. So obviously your PE will be much more favorable. So wherever there are tax treaties, the taxpayers will try to invoke the PE definition. But where there are no tax treaties, for example, India does not have a tax treaty with Bahrain. So in such a scenario, if a Bahrain entity tries to do business in India through these agents, and all those three conditions get satisfied, or any of these three conditions, habitually exercise an authority to conclude, the Indian agent concludes contract, Indian agents maintain stock, the Indian agent habitually secures order. In all these situations, the Bahrain company will have a business connection in India, and certain percentage of profits that the Bahrain company makes has to be attributed to in India, and taxes to that effect has to be paid in India. This is broadly the concept of business connection. Let's look at some of the why this is important. This is important both from as I mentioned to you, from an act and treaty, because more or less the same principles are there. Let's try to see some few instances of business connection. Now, if you go to question number 3, Mrs. Pedigree, a German health food company, sells its goods online. It has a subsidiary in India, Indian company, which stocks and delivers goods on behalf of Pedigree. On instruction of Pedigree, Indian company will deliver the stocks to Indian customers. The contract, the final customer contract, is entered between Pedigree and Indian customer. Will it trigger business connection for Pedigree, German entity? So now, is there a business connection? Now, think it regularly does business with Indian customers, because it also has a person who maintains, a subsidiary maintains the goods. So under the second aspect, that is habitual maintenance in India, stock of goods or merchandise from which he or she regularly delivers goods on behalf of the non-resident. So therefore, business connection, you can also give your answers and views as well. Business connection exists. Now let's look at next problem. Problem number 4. CAT company is a leading manufacturer of industrial equipment based out of the US. It has a subsidiary in India, Kitten Company. Kitten Company acts as a marketing arm of CAT company, wherein it will visit Indian clients and showcase the product. The final order will be placed by the Indian customer with CATCO, the US company, which will then directly deliver the goods to the Indian customer. Will it trigger business connection for CATCO? So Cadco is a leading manufacturer of industrial equipment. It has a subsidiary in India, and that subsidiary acts as a marketing arm, visits Indian clients and showcase the product. And the final order will be placed by the customer directly with the US entity. So therefore, will it trigger a business connection for the US company? Now, again, going back to, we need to find out, does the Indian kitten company habitually plays the principal role leading to conclusion of contracts by that non-resident? This is very important. Does the Indian kitten company plays the principal role leading to conclusion of contracts? So, or does it conclude contract, but that contract will be the name of non-resident? So look at how broadly they are worded, and it says habitually. So being a subsidiary company, there's a high possibility that regularly it may play the principal role leading to conclusion of contracts. So business connection may exist because of explanation 2A, habitually concluding contracts. In the above example, kitten company also negotiates the price. So yes, so now it is very clear. It also negotiates the price. So which means it does play a major role. So one can even say in point number 4 that it does not negotiate the price. It only just showcases the product. So that's why I use the word may exist. But now here it looks like business connection will definitely exist under 2A. So again, as I mentioned to you, these are very fact specific, and that's what makes tax treaty law, international tax very exciting, is because more than the literal or interpretation of the statute, the business supply chain also plays a very vital role. Now let's look at question number 6, further appreciate the business connection factor. Mrs. Abibas, a UK renowned sportswear company, has a branch office in India. The role of branch office is to identify quality manufacturers in India who can manufacture their product. However, the branch office manages the Indian website of Abibas and declares the final price discounts on the website. The Indian customer directly pays. So even though the website, but it directly goes to Abibas UK. Abibas India doesn't come. It manages the website, but the payment goes to Abibas UK. Is there any business connection? Yes, there is a business connection exists because they lead to the negotiation. Now, this is very interesting. These are all practical scenarios which I have tried to put so that you appreciate it better. Mrs. Billet, a leading US men's cycle manufacturer. Billet has a license office in India. The license office collects data on Indian market conditions, products, and services. It also holds conferences, talks, and participates in exhibitions to showcase Billet products. It also has a display showroom in Chennai, which displays the modern and latest cycles that is being manufactured. The LO does not undertake any sale activity. So the reason for me showcasing or putting across these examples is to show how complex sometimes the determination are, because each fact patterns differ, but the principles may also have. So in this case, I don't see the license office trying to habitually, conclude a contract or, play the principal role. They're only trying to do a display activity and other activity. So one needs to be, so in my view, business connection does not exist in number 7. I'll quickly run through 8 and 9. this is very important. Now, what does explanation? There is one exemption to all these things. That is, if that agent if he is an independent agent, that is, if any agent having independent status are not included in business connection. So you have to prove that the Indian party which tries to carries on business, where the non-resident carries on business through the Indian agent, if it can be proved that he is doing it on his independent status, the ordinary course of business, then in such scenarios, business connection should not exist. Now, how will you determine whether it's independent or not? The contract will have to determine, and also his actions. Who is an independent agent will work independently without any influence. So you have to ensure the contract and see if it is really is acting independently. Look at this question number 8. Messrs. CK, a leading US-based innerwear entity, appoints an Indian distributor, Messrs. JK, to sell its innerwear for retail market in India. Messrs. JK contract with CK stipulates that he cannot act as distributor to any other entity in the retail sector. He cannot act as distributor. The the agent charges a commission of 10% for every sales made to retail houses. Further, the agreement also stipulates that JK will employ 2 personnel identified by CK who will provide market research analysis, best sale practices, etc., etc. So bottom line, it appears that JK is not an independent because the contract says he cannot do for anybody. So which means his independence is defeated. And they're also sending in employees. So basically the non-resident treats the Indian agent as a dependent agent. This is exactly what is called under the PE terms, one of the PE terms, fixed place PE, the other is called dependent agent PE. The 3 conditions we saw as business connection. In the PE language, it is called the DAPE, dependent agent PE. If he is not dependent, he is independent, then no issue. No business connection, no PE. So therefore, it is also very important to see whether the agent may look like an independent agent. But if you look at the contract, it will clearly specify that he will literally have to play tunes to what the principal has mentioned. So that way, he may not be an independent agent. Question number 9, I will leave it to you for an assignment. You can have a look at that in the problems. Basically, I'm trying to cover this particular part for the provisions. So it's not only about goods. Please be noted. It's not agent need not act only for goods, even for services. So that's the point which I wanted to drive in problem number 9. On that note, just quickly look at section 1, the fundamental which we discussed. Yes Private Limited, having registered head office in Singapore, for the first time has carried out operations during financial year 21-22 of purchase of goods in India on 4 occasions. Immediately after purchase, the company exports the same to China. That is, the Singapore company buys goods from India and then immediately exports the same to China. The total value of such exports is 100 lakhs, on which it earns profit of 20 lakhs. Now, the company wants to know whether it is liable to tax in India, meaning, in other words, the company wants to know whether there's a business connection in India because of the purchase of goods it does from India. Answer will be no. the business connection should postulate into a real intimate connection as emphasized by the Supreme Court in R.D. Agarwal's case. Mere purchase or mere isolated straight transactions will not tantamount to be having a business connection. So therefore, there has to be a regular feature of transaction. Now, with this, we are done with 9.1 clause 1. Very important, especially relevant after in 2018, the business connection clarification shall included the agency related business connection, habitually concluding contract, habitually maintaining stocks of goods, just having a warehouse only to maintain and deliver, even that will create a business connection, and habitually secures orders in India. Mere securing of order for non-resident, but habitually securing in all these conditions, it will trigger business connection in India. There is also one more business connection that I will not touch now. I will do that along with equalization levy. That is explanation 2A to section 911. That is something called significant economic presence. So if you look at my first situations, all the situations I was talking about having an agent in India, a branch office, a license office, a distributor, people were in India. But today, thanks to digital epoch we are in, I don't need anybody in India for me to do a business. Facebook, Google doesn't need. Netflix doesn't need anybody to promote. All it needs is keep pushing trailers, article, the releases in YouTube, advertisement, through your data and other aspects they get. Enough. They don't need somebody to keep coming and doing marketing or sell to you, unlike your other retail distributions. So therefore, these digital companies there's now no need for you to have a presence in India, a physical presence. So therefore, in line with the modern day, the business dynamics, and there's a global discussions that's happening parallelly on how to tax these digital economies in a world which is largely digitalized. So therefore, the concept of significant economic presence, that is, look at the word they use, is economic presence. So I will go into economic presence, the SEP, along with equalization levy, so that you can appreciate the taxation of digital economy in a better fashion. Now, having looked at business connection in India, the rest are all pretty straightforward. Through or from any property in India. So, or through or from any asset source of income in India. This is very simple. If I have an equipment in India and if I lease it out, it will get taxed. So therefore, through or from any property in India, through or from any asset or source of income in India, that is, if I get any income by, it may be between two non-residents, but no problem. If the asset or source of income is in India or from a property in India, then in such a situation, it will get accrued, deemed to accrue in India. The last point is very important, transfer of a capital asset. So capital asset as defined in your section 2, clause 14, and in line with your capital gains. Now, what was very important was there were a lot of amendments that happened. I'm sure many of you would be aware about the Vodafone case. Maybe I will just quickly for better understanding. So, concept of indirect transfer was introduced through a capital asset situated in India, directly or indirectly. That is, X Inc., which is a US company, very hypothetical example. This X Inc. US has a subsidiary in Netherlands. That in turn has a subsidiary in India. Now, there's another company called YINC, which is again a US based. Now, YINC is interested in getting into India or want to buy the Indian company. So therefore, what ideally should be done is Netherlands to sell its shares which it holds in India to Y Inc. So ideally it will be Netherlands to sell Indico shares to Y Inc. This is plain vanilla capital gains. But now what will happen is instead of Netherlands selling, X Inc., the ultimate parent, X Inc. will sell Netherlands shares to Y Inc. So if Netherlands goes here, if mother goes, sister also goes or daughter also goes. So instead of Netherlands selling India shares to Y Inc., X Inc. will sell Netherlands, which may normally be just a paper entity. These are called intermediary holding companies, normally situated in some tax havens. Netherlands is a low tax country. So what US will do is sell Netherlands shares to Y Inc. So when Netherlands goes there, India will also go there, and eventually the structure will look like this. Y Inc., Netherlands, India will come under Y Inc., which is the buyer. So now what people were essentially doing is, so they were contending that the shares of Netherlands were sold and not Indian shares were sold. So there is no capital asset situated in India. So deemed to accrue or arise in India won't trigger. Deemed to accrue or arise in India won't trigger. So therefore, there is no capital gains tax in India. This was called the famous Vodafone case when Hutchison SR sold to Vodafone. This was, through a chain of entities. Idea was Vodafone wanted Hutch India, which is a huge telecom at that point in time. India still, but of course, not getting into the telecom industry now. It's a different ball game. But considering the subscribers, so Hutch, instead of directly selling India, sold one of its Cayman Island company, which in a link in a vertical hierarchy, there were a lot of other intermediary companies, and thereby they took a position that there is no transfer of a capital asset situated in India, because I'm not selling Indian company capital asset. I'm selling shares of Netherlands in our example, which I gave you. So therefore, there's nothing to do with India. Transaction is happening between X Inc. and Y Inc., two non-resident US entities, selling shares of a Dutch entity. Underlying asset may be in India. Okay, no doubt about it. Substance may be that I wanted India, but the law did not specifically provide for it. So therefore, they said transfer of a capital asset situated in India. Now that is why this was also added, whether directly or indirectly. So a lot of amendment happened under explanation 5 to section 9 clause 1.1 on indirect transfer. So now going forward, if the underlying asset is in India, then that will also get caught in India. Income through the transfer of a capital asset situated in India, through or from, directly or indirectly, through shall mean. Look at how India had to, after the bitter experience of Vodafone, through shall mean and include and shall be deemed to have always meant and included by means of, in consequence of, by reason of. So they had to expand all sort of, and ironically, the Supreme Court in 2012 said that the Vodafone sale was valid, it is not taxable because there was no mechanism under the Income Tax Act to tax. So to nullify the Supreme Court judgment, it was retrospectively amended, and you would have seen the newspaper. India now recently took back the retrospectiveness. It went to bilateral investment arbitration, etc., etc. That's a different topic. So bottom line is now they have made it watertight. Going forward, it will be very difficult to take a view that indirect capital asset is not there, because explanation 4, more importantly explanation 5, have adequately covered and also mentioned when will such indirect transfer gets taxed. So you can have a look, you can please go through it whenever you get time. So the crux is basically non-resident transfer of an Indian company shares or any capital asset in India, directly or indirectly. Then the non-resident seller will have to pay tax in India because it is deemed to accrue or arise in India by virtue of Section 9, Clause 1, Subclause 1, Explanation 4, 5, Explanation 6, Explanation 7. So all these are basically Vodafone related amendments. Now I'll go to Section 9(1)(2), income from salaries earned in India. This is again very important considering the fact that a lot of foreign companies which has subsidiary in India deputes a lot of their foreign employees to India. Now what normally happens is, say a Dutch company, this happened, a Dutch pharmaceutical giant, you'd have heard Eli Lilly, had a joint venture with one of the Indian pharma companies, Ranbaxy. Now, Dutch, as part of the joint venture in India, Eli Lilly India, the parent company seconded few of its employees to Indian company, and the salary was like this. Let's say if the salary was 150, 130 was paid in Indian bank account, 150 was paid in account. Over and above, the parent company had agreed to pay 20 rupees to its home account. So this is basically, which is very normal. Let's assume tomorrow you work for a firm or a company, and that company says you need to go to Sri Lanka. Now you will get salary in Sri Lanka. Over and above, to incentivize you to go to Sri Lanka, the company says, the company which sends you says, you go to Sri Lankan subsidiary, you will get your salary there. And over and above, I will send the Indian company, I will send some amount, I will put some amount in your Indian bank account so that your family can withdraw it. You don't need to every time send it from Sri Lanka to India. So this is very common in a multinational enterprise structure. Now the question was, this amount that was paid when these foreign employees were deputed to India, taxes was deducted, no issues. The question was the small amount that was contributed by the parent company to the employee's home account in Dutch, will that amount to taxability in India was a question. See, for whatever services that were rendered in India that were agreed by the Indian company, TDS, everything was done. But as part of the normalcy, because they are developed country, they're coming to a third world country like India, and even otherwise for convenience, they said, look, I will put some amount into your home account so that you don't need to keep sending forex fluctuation, all those things. So your family can withdraw. Question is, that small amount, will it be taxed? In India was the question. The Supreme Court said, yes, it is taxable. Why? Because that amount, whatever he has got in his home bank account, in his foreign bank account, in home account, is because of a salary that is performed or earned in India. So Section 9, Clause 1, Clause 2, sorry. So Section 9, Section Clause 1, Clause 2 to this effect specifically mentions that if the salary is payable for services rendered in India, then in that case, it would be taxable. So therefore, as long as the services are rendered in India and payment may happen to any account anywhere in the world, but if it is for salary earned in India, Section 9, Clause 1, Subclause 2 says it is deemed to accrue or arise in India. 913, as I already mentioned to you, this is for salary payable for government officials, those who are working in embassy. So, because since the salary are paid outside India, in order to bring them to tax into India, it is deemed to accrue in India. You may ask, why is that? Because their services are rendered outside India. Why are they taxed in India? Because these are embassy officials and these are paid by the government. Indian government is paying it. So therefore, they are saying, no. Even though you are rendering service outside India, but it is for Indian government, so you should, that amount will be deemed to accrue or arise in India. That is what Section 9, Clause 1, Clause 3 says. 9, Clause 1, Clause 2 repeat. Any services rendered in India for which salary is paid, it may be paid anywhere in the world. But if it's towards services rendered in India, then it would be treated as earned in India and thereby deemed to accrue or arise in India for the non-resident. Now, last point on the dividend. So this is now we are in a dividend, no more in a dividend tax regime. We are in a proper dividend regime. So any Indian company which makes dividends to its foreign shareholders, the foreign shareholder cannot say that this is not accrued in India. It is deemed to accrue or arise in India by virtue of Section 9, Clause 1, Clause 4. So any dividend paid by an Indian company outside India is deemed to accrue or arise in India and would be taxable in India in the hands of non-resident shareholders. So therefore, if you see all these things, see these are, you maybe wonder why do you need such clarification, but then non-resident shareholders were taking a stand that, these dividends are accrued outside in their home country, therefore should not be taxable. But however, in order to avoid such claims, 914 clearly specifies that it is taxable in India. So what I would do is, I will stop here just to recollect, quickly recapture what we have done on the source of income for non-resident. It is deemed to, the main important point is deemed to accrue or arise in India under Section 9. Section 7, deemed to receive in India is not an issue. Similarly, income accrue or arise in India is again can be decipherable. If it's still not able to accrue, you can go look at Section 9 and see if it is deemed to accrue or arise in India. If it is deemed to accrue or arise in India, then the non-resident will have to pay tax. So we saw 9, Clause 1, Subclause 1, which is basically into business connection. So any non-resident trying to do business, having a business connection in India, then that income has deemed to accrue or arise in India, and to the extent that is attributable to India, will have to pay profits will have to show that income in India and pay tax to that effect. So we saw the different intricacies like having an agent, dependent agent and independent agent. So any agent who habitually maintains stocks, habitually procures order, habitually concludes order, habitually leads to conclusion, habitually secures. So all these things will cover as dependent agent, and only if he acts as independent agent, he can get away. That is, the non-resident can say, I am using an independent agent, so therefore I am not doing business in India. Property, source, all very simple. Transfer of a capital asset, I just dwelled upon the fact that it is now very extensive to cover Vodafone-like situation, indirect transfers. Then we looked at dividend and salary. So in the next class on Friday, we'll be looking at the other passive incomes, interest, royalty, FTS, and also we'll touch upon what are the tax rates for them along with the withholding tax aspects that is there. So what I will do is I will stop screen, and I would request you all to, just tonight to refresh, or tomorrow morning, just go through the poem provisions 1 and then look at section 9. So this way you will have a complete grip and understanding on the subject. If there's any doubt, I can always discuss in the subsequent sessions. I'm looking at the questions. I understand, but amounts and accounts are maintained. No, accounts are maintained was just one of the indicators, Namita. I agree, may not necessarily lead to key decisions, but you look at various factors, and one of the factors, if you're not able to get to a conclusion, some treaties also mention that if accounts are maintained in the home country and not in the foreign subsidiary or foreign country, then you can also take a stand that there is some management happening only in the home country. That's the point. This is your question 26. Now, okay, please explain. Oh, okay, okay, good point. Exclusion of business connection. So, what I will do is I will. There are some exclusions. So there's a question specifically asked: is there any exclusion for business connection? Yes, I have a slide as well. I didn't touch upon it. There are 4 or 5 situations where it is specifically excluded. Anyway, I will be sharing the slides. You can have a look at it. But since specific question on exclusion has come, you exclusively, it is only for purchase of goods for purpose of export. Then in such a situation, it is excluded. Similarly, if operations of non-resident is confined to shooting of cinematograph films, this is to promote shooting, collection of news and views for newspaper agencies and independent agents. So these are the exclusions that is available for which business connection won't be there. So that is, if my operations in India is only for purchasing goods for the purpose of export, then not a problem. I have an office, I buy from India and I export it. Similar to example, you saw Singapore company buying in India and exporting China, there won't be any business connection because this promotes Indian goods being exported. So that's the reason why this is not part of. This is part of exclusion. Contract is concluded, goods delivered to customers, so you can come under C point of. Yes. No, contract is concluded. No, you'll come under point B because point C is secures order. That is, I act as an agent in securing. Point B is I solely deliver and maintain goods. In Q7, as inventory is maintained by agent, so why can't it come? I agree. It may also that. Or the point what I wanted to bring upon is it is very fact specific, there could be various issues. So yes, I want you to understand the three main elements in what could constitute a business connection from an agency standpoint. That's the objective. And last question. Yes, regularly purchase goods from India. What the last question is, 1 moment. No, if yes, even otherwise, if yes, regularly purchased will come under exclusion, Namita. If Mr. John has an FD in India, will it be treated as source of income in India? Yes, if John has an FD in India, non-resident, it will be treated as, that is very simple, straightforward. He has a asset in the form of an FD. So therefore, it will become a source of income in India. No, the retro tax was repealed. So repealed. Now what happened was this amendment came in 2012, Naveen, explanation 4, 5, 6, 7. But what has happened is Supreme Court said, no, this is not deemed authorized in India. So the government amended with in 2012, but with retrospective effect from 1963, when the act came in. So therefore, it created a lot of issues. So they were going and opening up all transactions that was happening prior to 2012. So now they have repealed it and say going forward, that is a prospective amendment. So from 1st April 2012 onwards, any such indirect transfer, that is the example which I gave of Y Inc., X Inc. selling its shares to Y Inc. Through a chain of intermediate holding companies will get affected post 2012. The Vodafone issue was, it all happened prior to the amendment, and the amendment was given a retroactive effect. So that is now government has taken back after they lost the investment tribunal cases. So it is still valid. So anyway, they will not go ask about retrospectivity, but they will ask whether such a transaction will amount to tax in India for the seller. Yes, by virtue of Section 9, Clause 1(1), transfer of a capital asset situated in India will also include indirect transfers. Dutch employees has salary agreement in Dutch country. So how Indian government will come to know about such terms of agreement? Good point. How Indian government will get to know about the terms of agreement? See, now there are two ways. This is quite easy to happen, Namita. Now, what will happen is either they will ask the Indian company to pay 150 plus 20, 170 as salary, that is 150 towards services rendered and 20 as a loyal stuff, and ask India to pay 170, and then they will give it to India. Or alternatively, they will also ask for the secondment agreement, they ask the expatriate to produce all the relevant agreements with with both the Dutch. See, I'll tell you, this is a very big concept. I'll not get into it. Normally speaking, that's why I use the word seconded. You are in your articleship, you register with the principal. That principal can second you to another chartered accountant. But the principal with whom you are, he will be the primary principal. He will second you to another CA firm for 3 months, 6 months, 1 year, where you will get exposure and other aspects. But then your primary supervisor or primary principal will remain. So this is what will also happen in an M&E situation. A Dutch company will still have the employee in his roles. They will do a secondment to India. Now, why are they doing this? Because if they terminate his agreement and say take up employment from India, they will lose social security benefits. Social security is very crucial in these developed countries because that contributes almost 40-50% of their salary. And that is very vital for them. And because the government gives pension after that, and for them, social security is very important. So just like that, a person won't resign from his home country and go to its group entity. Anyway, that's a larger mechanics. So they'll always have some ways to come to know the information. Okay. So I don't see any further questions. So in that case, thank you very much. Good night. We will catch up again on Friday. Please, until then, try to go through whatever we've discussed. So they'll help you, in terms of quick revision during an exam time. You can spend very little time at that point in time. If you have any questions as well, it'll be easy to get it sorted when I'm around with my sessions. All right. Thank you very much. Good night. Bye.